In this video, we're going to briefly look at some of the primary issues involved with deciding what kind of retirement plan is right for your business. My name is Brad Thomason, and I'm the Managing Principal at Thomason CPA in Birmingham, Alabama. Thanks for taking a few minutes out of your day to be with us as we run through this information. Even though we all have different goals and preferences, and have chosen different careers and pathways for getting there, in the end, most of us have a similar aim. We're all trying to get to that point that our savings can pay for our lifestyle so that we don't have to work forever. That is, we're trying to get to the point where there's a transition between a lifestyle that's paid for by our efforts to one that's paid for by our assets. If you ask people why they save for retirement, in the vast majority of the cases you're going to get an answer that is some variation on that theme. Most people think of their retirement money as what they've put into various formal retirement accounts they have, like IRAs and 401ks, plus whatever those amounts have earned since they were put in. But a broader definition is probably the better one. Whether you call it retirement money or not, what's really going to fund your retirement is your savings. And the broadest definition of savings is whatever you made that you didn't spend. In other words, it's all of the surplus, regardless of where you have it socked away. Sometimes we hear people say that they can only save some X amount because that's all their retirement plan allows. But that's not an accurate statement. Even if there's not room for it in the formal retirement plan, you certainly don't have to spend it. Still, we do want to maximize the number of savings dollars that end up getting the benefits that retirement plans offer. What are those benefits? Well, there are primarily two of them. Tax deductibility for the contributions when they go in, and tax deferral on the earnings during the years between the money going in and the payouts that occur during retirement. The good news here, and really the message of this video, is that business owners and executives get to have some control over how much of their savings are going to get special tax treatment simply because they are the ones who decide what kind of plan or plans the company is going to make available. At the simplest level, we want to figure out how much is going to be available for saving and then construct a home for just as much of it as possible. Now, to quantify that these are significant benefits and well worth the minimal amount of effort that's required to set the stage for getting them, let's take a look at some comparative results. This is a spot where a picture is going to do a better job of demonstrating. So here we have 4 columns, each one showing a different hypothetical result. Let me walk you through what we're looking at. In each of these scenarios, we started with a zero balance. We added $1,000 every year, and we let the accumulated money pile up and compound at a rate of 7.5% a year. Did that for 25 years. We're using this format to isolate the effect of the benefits we're after, deductibility and deferral. Remember, deductibility means we get to take a deduction against our other items of income in the year we put the money in. Deferral means that we will eventually have to pay the taxes on the earnings, but they aren't going to count as income right now. We get to put it off until some later date. The first column is what we would call the cash account. It's essentially what you would be looking at if you took what was left over from your paycheck and sent it to Fidelity or Schwab or whomever. There's no deductibility for the amounts going in, no deferral on the earnings over the succeeding years. All taxes are being paid as they're incurred, and the ending amount represents money that's yours to do with as you please, free and clear of any future tax liability. So the lower section is going to be what you put in, and the section just above it is how much that amount earned. Now moving on over to the second column, that shows what would happen if we'd gotten deductibility but not deferral. That additional green section at the top is our benefit. The third column is just the opposite. It's deferral of taxes on the earnings, but not deductibility on the contribution. Column 2 and column 3 are shown net of taxes to make them comparable to column 1. And by the way, the tax rate assumption for all of these was a combined state and federal rate of 30%. Alright, so deductibility is good, and deferral is good. And for that matter, just plain old savings is good too. In that first column, we put in a total of $25,000, right? $1,000 a year for 25 years, and we ended up with $36,000 and change. So the difference is what the savings earned, and it's a pretty good result in its own right. But look what happens when you put them all together. That's the fourth column. We saved money, got to deduct the contributions, and we got deferral on the earnings. We've more than doubled the amount of money we put in over the years. Now, there's no magic to the fact that we only used $1,000 as our contribution amount. The numbers are scalable, so you can double them, triple them, add a zero, whatever. You can add 2 zeros if you want to. Irrespective of any scale adjustments you wanted to make for the example to be more comparable to your actual portfolio size, the proportional results will stay the same. So, with all of that just said, if I ask you which result you would prefer, you're going to say, give me all of them together, right? Give me column 4. Well, of course. And that's largely what we're going to be looking at under the category of retirement plans known as qualified plans. The term qualified basically just means that the plan meets Department of Labor and IRS standards and therefore qualifies for the special tax treatments, deductibility and deferral, at least within limits. Now, those limits are what cause the confusion. What we have to do is look past them and use what we've just learned. Even if we can't get all of the benefits on all of our savings, maybe we can get some of those benefits. There's another class of plan types out there called the non-qualified plans, which may make that a possibility. And where qualified plans tend to require equal treatment for everyone in the company and limits on how much money can go in, non-qualified plans usually don't have those same restrictions. They can be reserved just for the owners and the executives, and there may not be any limits on how much can be saved. So, qualified plans may get more tax benefits for amounts that can be included, but the non-qualified plans have some pretty powerful characteristics as well. Ideally, what you'd like to see is a case where the first dollars of savings go into the right kind of qualified plan, and then have non-qualified options in place for some or all of what remains. Remember, if we don't want to stop saving just because we hit a contribution limit in our primary plan. We want to add structure to try to get benefits, even if not full benefits, for as much of our retirement savings as we can. How we do that, though, is going to take some custom tailoring, because the underlying reality of this whole discussion is the fact that with so many options available, it can be very difficult to figure out what's best. Now, our approach is to start out with a simple 3-question test that we developed to try to get to the heart of the matter as quickly as possible. The answers guide us toward which plans and plan combinations we should automatically disregard and which ones we should leave in the running. That is, they help us narrow the field. The first question, is your company in an industry where it's expected that the employer will make contributions to the staff's retirement accounts? Next, we want to know if your company has the kind of workforce that makes it likely that employees will want to make additional voluntary contributions out of their paychecks, or are their accounts more likely to just be accumulation of the employer portion? Finally, and this is really the big one, would the owners and maybe the executives or senior management people put more into the plan if the limits were higher, or they could do so without adding to what the other employees were to receive? In other words, are there still savings left that need a home once the qualified plan amounts are tapped out? The answers to these 3 questions don't solve the riddle all the way, but they help to make a very good start toward determining what the right plan or combination of plans is for a given company. From there, we can work together to accept or reject the options that are left on the table to end up with the combination that's going to work best for your company. So that's our presentation for today. Thanks for joining us. If you have questions or would like to speak to us about setting up a plan assessment for your company, please call us at the number below. Having the right plan or set of plans in place can literally lead to a business owner or professional practice owner having hundreds of thousands of dollars of additional retirement savings over the course of time. That's why we think this is such an important topic. And since our practice is advisory only, we don't do taxes or audits or any write-up work, bringing us in to advise on plan configuration doesn't mean that you have to stop working with the CPAs that you use for those other functions. So please let us know if we can be of service to you. And again, thanks for joining us for this video.